next, let's talk about asset allocation. A lot of people ignore it, but herein lies the power to actually make or break your portfolio. Ashish Shanker, Head of Investment Advisory at Motilal Oswal Private Wealth Management, is with us. Hi Ashish. So, how does a person actually decide which is the best asset allocation? Because as I understand it, it can't be stagnant, right? So we've seen, this year, last year, it was gold, which was tops all the way. Before that was an equity rally. 2016 was perhaps the best year to have been in debt. So how does an investor decide how should their asset allocation be positioned?
Right. First of all, Sumaira, it's always a pleasure to be on your show. And this is a study which we did across 30 years. And the reason we did this study was often investors chase the best performing asset class, in the sense that since gold has done extremely well, today everybody wants to invest in gold. Similarly, in the past, we've seen whenever equities do well, a lot of people tend to crowd their investments at the peak of the equity markets. And invariably what happens, there is a concept called mean reversion, where after that the asset class doesn't perform for a period of time, and hence it ends up in disappointment. People don't like negative returns and people don't like to underperform. Hence what we saw was, if you study asset classes over a period of time, over the last 30 years, 16 out of those 30 years equities has done very well. But still people are not able to be in equities because there are certain years where equity also falls sharply. So the whole concept of asset allocation is to combine different asset classes which behave differently and which perform at different points in time, so that when you put it together, the portfolio as a whole is far more stable than the sum of the parts. That's the whole idea.
Okay, so I take your point that basically the entire portfolio, if it rises together, then that means that at some point it's also going to fall together, right? Now, I know it wasn't possible for me to showcase, data across 30 years, so I've just chosen very, very recent data, but it will highlight the fact that, different asset classes perform at different times. But Ashish, what would happen if someone would have, invested in, say, an equal weight portfolio, right? So you divide equally to gold, equity, cash, debt. Would that have been better than being overweight any one of these?
Yes, so we did a simple experiment. We said, let's say if you started in 1990, which is 30 years back, and you equal weighted all these asset classes, and you followed a simple rule, that is, at the end of the calendar year you brought it back to equal weight. So for example, if equity did extremely well, then you reduced equities and put it back in the asset classes which have not done that well. Now, this simple portfolio over a period of time would have beaten all but one asset class, which is equity. And we know that equity comes with a lot of volatility. So to give you a perspective, equity over the last 30 years has delivered close to 14% compounded annual return, right? Gold, again, which is a very volatile asset class, has delivered close to 10%. But if you just combine gold, equity, debt, and cash in equal weight and adjust it at the end of calendar year, would have delivered you 11% compounded annual return with a standard deviation, which is nothing but volatility of the portfolio, lower than both gold and equity. So that's the beauty of asset allocation. Now, why does this happen? Because there is a concept called correlation. Correlation, to put it in very layman's language, is that each of these asset classes perform at different points in time. So they're not correlated. So for example, when equity does extremely well, there is a high chance gold may not do well, and vice versa. So for example, this year we've seen equities not perform and fall sharply, but gold has done extremely well. So something or the other in the portfolio negates the asset class which doesn't do well.
Okay, another interesting facet of this study that you did was around mutual funds, right? And specifically about, whether the best performing funds continue, holding on to their high rankings, do they slip? What does this mean for an investor? Because traditionally we've been told that, you find a good fund and stick to it for the long haul. Is that really true? Is that what you found after your study too?
Right, so now we are digging one level deeper into equity as an asset class, and within equity what we have generally seen is the funds which have performed well in the recent past, there is 1 year, 3 year, 5 year, tend to attract a lot of money naturally, because you invest based on past performance, but what you get is the future performance. So we did a study right from 2010, and we took the top performing funds based on 3-year returns, and then we ranked them, right? And then we saw how they perform in the next 3 years, because as an investor, you're looking at the past 3 years, but what you're getting is really the next 3 years. Now, it was very, very stark. So the top fund house or the top fund in terms of returns never ended up being even in the top quartile. It invariably ended up in the bottom quartile, which basically tells you that past performance are definitely no indicator of future performance. So what we suggest is, instead of looking at the near term 3 years performance, one has to look at the longer term consistency of the fund manager. What is his philosophy? And generally, you got to stick with funds if you have conviction on the manager through longer periods of time.
Yeah, sorry, I focused on that a bit more because it is an area of personal interest, and your findings were, well, what can I say, quite amazing, really, and quite revealing in what they show. But let's go back on an, overall asset allocation level. The key that a lot of people want to know is that how do they, okay, I've created an asset allocation for my portfolio. How do I rebalance it? When do I need to rebalance it? And also, this whole thing of trying to enter or exit, I mean, is that the worst decision that investors can make? Is it even worse than perhaps choosing the wrong fund?
Yes, Sumaira, actually, there have been a lot of international studies which have been done, and it is no different if you apply it to Indian market. Then 90% of any investor's return during his or her lifetime depends on which asset classes you're invested in. So a lot of people anecdotally tell me, this stock did extremely well for me, this fund did extremely well for me. And then when I ask them how much have you invested in it, it will barely be 2-3% of their overall wealth, right? So first 90% of your outcome depends on how you allocate your money across different asset classes. You got to get that right first. Now, we showed you a very simple portfolio, equal weighted across 4 asset classes. Now, depending on your ability to withstand volatility, that is simple up and down movement of value, or what I call drawdown. Actually, drawdown is even more pertinent, because I always tell people that the sentiment you feel at the bottom of the market is your real temperament, and you should design portfolios around the worst outcome. So if you are willing to take a little more volatility, you can move that 25% equity to 50. You've seen an equal weighted portfolio itself has delivered double-digit returns. Now, in terms of rebalancing, I'm a big fan of rules or having some framework around rebalancing. Otherwise, we get carried away by the narratives of the day. Just look at what happened in March, right? March markets tanked, people were worried about this pandemic, and a lot of investors, I think me included, because we are all human beings, we got so carried away by the narrative, we thought this is the end of the world, and many people actually didn't invest. And guess what? A lot of people actually took out money. So a simple rule-based rebalancing, it could be on an anniversary. You can say that I'm going to rebalance every year. You can say I'm going to rebalance every 3 years. Now, a little more intelligent investors can look at valuation frameworks. So equity is the most volatile asset class. You can say that, above PEs of 20 to 20, I will be underweight equities, or below PE of 16. I'm just trying to keep it simple. But the summation is, I have seen that if you have simple rules and simple frameworks, they are more likely to withstand the test of time rather than any complicated, formulae based or other complicated frameworks that you lay down for your asset allocation.
Yeah, no, I take your point entirely. Basically it has to be a conscious decision based on logic, data, and of course the current environment. Ashish, thanks very much. I'm going to put out some of your slides on Twitter actually for the benefit of our viewers, and thanks very much for joining in with your insights today. With that, we'll take a very quick break, come back in a bit. On the other side, another interesting topic. Debt mutual funds have seen investors jittery over the last few months, but now market regulator SEBI is looking to overhaul this. They've made a working committee. What does this mean? What can be the scope of this overhaul? All of that is lined up next with Capital Minds' Deepak Shenoy. Stay tuned.